So, good morning, everyone. Welcome to the latest K Johnson G online event in current circumstances. You're all very welcome to the latest in our series of events helping you and your clients build a better business. We welcome this morning, I'm delighted to say, Matthew and Andrew from Brooks Macdonald. Brooks Macdonald, as some of you will know, are an investment management services business around the world, providing services to high net worth individuals, pension funds, institutions, and trusts. We'll be joined later on screen by Andrew Benny, who's an investment director with Brooks Macdonald, managing client portfolios for this Q&A part of the hour. But first up, we have Matthew Cady, who is a member of Brooks Macdonald's Asset Allocation Committee, and as such helps shape their investment strategy decisions. So he's going to be sharing his views with us this morning, I'm delighted to say. So over to you, Matthew.
Thank you very, very much, Stephen. Just checking a sound check. You can hear me okay?
Yeah, it's fine. Yeah, perfect.
Perfect. Well, thank you very much, everybody, for giving up the early hour of your day to give me the chance to share my thoughts and our thoughts about the investment landscape as it is currently. I think it's clearly a very interesting time to have this discussion. Obviously, not least the US election results last week, but also the events of the last 24 hours with potential vaccine hopes from Pfizer and BioNTech. But there are a number of narratives I'm keen to get across, and one or two really, I think, central messages, which I think will, in all likelihood, dominate the medium to longer term investment narrative. And part of that has been reshaped by the elections last week. So I think I've certainly shared with the host today a couple of presentations, which I'm very happy for those to be circulated after the meeting, and hopefully they will provide some resource for you. But I'm going to go through a few key slides here. You'll be pleased to know I'm not going to try and go through all the slides in this slide deck. I think most investment strategists tried to seek some sort of comfort in that. The more slides you have, hopefully, at least you have a chart or a graph that can hopefully respond to most Q&A, but we don't plan to go through all of these charts today. I'm going to try and pick out, I think, a selection of charts that will hopefully represent the narrative and the views that we have. So I think let's get going. I think a good place to start is probably the US elections. So on screen here, hopefully, if my screen sharing is working, you can see a screen titled "The Race for the White House was much closer than polls predicted." If that's not the case, do shout, but otherwise I'll press on. So US elections last week, clearly much closer. I was reading reports this morning from one of our research providers that suggested that it would only have taken a 25,000 vote swing, I think, across 3 states, Arizona, Wisconsin, and Georgia, last week, to have tilted the Electoral College votes almost as a tie between Donald Trump and Joe Biden. And whilst it's a winner-take-all in the states in terms of the Electoral College system, beneath the surface, you can see very clearly that the vote was very, very close. You can see on screen here, for example, you're talking fractions of a percent in some cases in terms of separating 2 candidates. It's also worth noting that Trump got an estimated 47.7% share of the vote, and looks to have won 24 states, and he got more votes than Obama got in either of his 2 successive campaigns in 2008 and 2012. So clearly, I think there is certainly merit to suggest that, against all expectations of a Democrat blue wave that was predicted to wash over all 50 states, I think that blue wave kind of washed out on election night, and it's still in many ways a very divided country, and there'll be question marks about just how strong a mandate a Democrat administration might have to pursue some of its more reformist agenda. But I think if we go on to this slide, I think all eyes really are on Congress. And the way that the market rallied last week, and I think it will likely shape going forward, is how Congress shapes up. So Congress in the United States is two houses, the House of Representatives and Senate. House of Representatives is likely to stay Democratic, and you've got a Democratic presidential post as well. But with Senate, it's looking much more finely balanced. So right now, you've got 100 states in the Senate, and there are currently 48 seats tied with Democrat, 48 seats tied Republican. Republicans are expected to win Alaska and North Carolina. That means Democrats need to win at least, or need to win both the Georgia runoff states on the 5th of January. So just to explain that, so unusually, most US states, they have a sort of a plurality system. So even if you get below 50%, if the next guy gets less than you, you still take the seat. With Georgia, it's different. Even if you beat your opponent, you still have to get north of 50%. So you have to get a simple majority. If you don't get that, two leading candidates go to runoff on the 5th of January. And unusually, you've got two Georgia seats in runoff now. Normally, states have one Senate seat at any one time up for grabs. But Georgia, one of the Republican sitting senators was unwell. They retired for ill health, and so that's why you've got two Georgia seats. But if Democrats flip those Georgia seats in January, you're then at 50-50, and whenever you have a tie in the Senate, the vice president, which obviously is now Kamala Harris, can tip the balance and vote. So the likelihood at the moment is very much that it will stay Republican. When you look at Georgia, it's a deeply Republican state that has shifted. Demographics are shifting. Demographics are shifting quite fast in Georgia. So the capital of Georgia, which is Atlanta, has seen a lot of net inward immigration from other states in America. So what has historically been a very older white demographic in Georgia is being rebalanced towards a younger demographic, a more multicultural, more ethnic representative demographic. And so that means that Georgia is more in play than it has been in previous elections. But you can see in terms of this screen here, the expectations, if you will, from financial betting markets about how those Georgia seats might play and who ultimately might control the Senate once all the seats have been decided. And I think I will forgive everybody for having a little less trust in the polls and betting markets than they might have done otherwise. Clearly, last week the pollsters were hugely surprised. Democrats were expected to win an 8 to 10% majority, and clearly that hasn't shaped up. But you can see here in terms of financial betting odds, which did actually have a slightly better predictive power ahead of the election, they suggested the chances Democrat blue wave was much more narrow. Currently, they're looking effectively for Republicans to have a sort of 75% chance of retaining at least one of those two seats. And of course, if you retain at least one of those two seats, you retain control of the Senate. The reason why I'm maybe going sort of at length in terms of the significance of this is it really does shape policy and the potential remit for policy going forward. If you have a split Congress, so you have a Democrat House of Representatives and a Republican Senate, that potentially can thwart the ambitions of a Democrat administration in terms of the breadth of policy reform it might look to engage in, whether that be across healthcare, in terms of financial regulation, technological regulation, and any changes around taxes, for example. So I think that is really quite important, and I think the market certainly responded to the news last week of the risk of a split Congress, the risk of a Republicans holding the Senate, because they thought, well, look, ultimately what you could have here is potentially the best of both worlds. You could have a Democrat administration whereby you are less likely to get tweets at 2 in the morning, and so it's going to be a more predictable administration, perhaps in that way. You're also going to get an administration whereby, because that split Congress, that will curtail the wider ambitions that Democrat administration might have had. So in that sense, you may get a less of a fiscal boost, a smaller fiscal stimulus that might otherwise have emerged had you had a Democrat aligned across all three power bases in American politics. And because of that, that means I think the balance of narrative shifts slightly less from seeing a fiscal response to having more weight put back onto central banks. So the baton for extra policy stimulus is handed back to the Federal Reserve. And in that sense, you've got this sort of framework whereby you have interest rates which will be lower for longer. And that will support the narrative of a lower growth world, in that world where reflation is somewhat held back, but global growth is held back. Growth remains scarce, and therefore growth risk assets are bid up, and that naturally plays to long duration stories like technology and healthcare, for example. As I say, just to go into some of the detail around the types of Democrat potential policies on the screen here, you've got the 4 key areas that markets will be paying attention to. So as I mentioned, corporate tax, healthcare, trade, and financial services. What was interesting in the election was that financial services and tech regulation really did play a back role. I think it was very much more about the response, the job one, which is the coronavirus pandemic, and how Biden will look to tackle that, but also around healthcare as well. And I think importantly, because, going back to that likelihood that the Senate stays Republican, some of the broader measures that you can see on screen here, I think will be curtailed. I think that the top one's the most interesting one. So clearly, in terms of corporate taxes, President Trump cut the headline corporate tax rate during his tenure from 35 to 21%. Biden's made no secret that he's seeking to raise that halfway back up to 28%. But the key question, and the one I think which is supporting a positive market outlook right now, is that he's unlikely to do that day one. You've still got unemployment in the US, which is coming down from elevated levels, but it's still elevated. Would Biden look to put another tax on corporate America just when he needs corporate America to support employment, workers' pay, investment, and help that sort of nascent economic recovery get a stronger hold? I think even had he, and let's play scenarios, even if you assume to be the most optimistic in terms of a reflation narrative, let's assume the Democrats flip control of the Senate, so they have a clean sweep. Even then, you're unlikely to see Biden, I think, push in the very near term on any of these measures. I think any more aggressive measures will be back end weighted to the end of his first term, and maybe even potentially a second term, whether that's under him or Kamala Harris. But I think the clear emphasis that he's communicated is very much around tackling the pandemic. And if you do get a fiscal stimulus in the next few months, there's every chance that the positive reflationary support from that fiscal stimulus might be in part netted off by the fact that Biden's much more willing to follow the science and support the scientists' recommendations, and therefore effectively be more willing than Trump might have been to shutter parts of the American economy if the science demands that that's what's needed to help tackle the very near term of the pandemic. I think let's move on to coronavirus. Clearly, as the US election focus falls away, COVID is going to regain attention. Started this week, you're now at over 50 million cases confirmed of coronavirus worldwide, and obviously fatalities north of 1 million. In the US, I think you're still seeing a significant elevation of cases, and I think overnight in the last 24 hours, you've had 144,000 odd cases in the US. So clearly, you are seeing cases pick up, but I think it's the second wave risks which is really concerning. And I think that the key point to tackle here, and you can see this on the screen, which is sort of evident, is that I think reassuringly there is a break between the profile we're seeing on confirmed cases and also on fatalities. So the market, the policy makers, health authorities, officials, they're getting better at containing the fatality impact of the virus by shielding the more vulnerable, the more elderly, and trying to discipline in terms of social distancing and all those sorts of measures which you hear on a frequent basis from Downing Street, for example. Let's just go to this slide, apologies. So here we've got just breaking that global picture in terms of coronavirus. Let's look at Europe and US. And you can see here that you've seen a definite pickup in terms of second wave. Just a point to note, these second waves are not directly comparable with the first wave, just because the higher incidence of testing and the fact that now, because you've got a much more stronger testing, which is pervading in terms of monitoring regimes, you're going to start, if you test more, you're going to get more cases. But there has clearly been a definite pickup. The US, I think, underscoring why President-elect Joe Biden iterated it so many times during his campaign, is that the US is really tackling a most definite second wave. This data here from RT Live, which tracks the transmission rates of the virus. So with a transmission rate of over 1, it means for every one person who has the virus, they infect more than one new person with the virus going forwards. If the rate of transmission is below 1, then the virus is starting to shrink in popular prevalence. So you can see here practically every US state at this point in time at the beginning of November was seeing a rate of transmission which is north of 1. Europe is seeing a similar pickup, and again reiterating the point that second waves are not comparable with the first because of the high incidence of testing. But you can see here how these cases have significantly picked up and made somewhat of an irrelevance the UK's 20 cases per 100,000 over a 7-day period quarantine guideline, which we were all keenly watching over the summer as we tried to make our escapes to sunnier destinations. So clearly there is a definite urgency in terms of trying to find a vaccine. This slide from one of our research providers, I think, just details quite neatly candidates that the market is watching. You've got a dozen or so here. Obviously, yesterday we saw news from one of these candidates in phase 3 from BioNTech Pfizer, where they suggested that interim trials, interim data suggested that they had over 90% efficacy. I think it's interesting to point out there are, this is an important hurdle to go over, but even Pfizer and BioNTech recognize that there are more tests to be done, more safety efficacy tests, and even President-elect Joe Biden released a statement yesterday saying that he had advance warning of this news, and whilst it's encouraging, it is literally the first step, and that efficacy rates can change as you have more candidates coming through in terms of data. But also he made the point that it's going to be many months before you have this vaccine at a point where you're able to try and get herd immunization. I think in the UK, for example, we've ordered a number of potential cases for this Pfizer vaccine if it's successful. I think reading reports, you're looking at I think 10 million cases by Christmas, and as you have to have a double dose, that's 5 million people that you can deliver the vaccine to. But I think what's important, and I think this is perhaps adding a little bit of caution around the moves that we've seen in the last 24 hours, is that, and I think this is going to lead me neatly on to what's shaping, I think, the narrative, is that even with a vaccine, if you think a year from now, that the fear of the virus has dissipated because you've got availability of one or more vaccines and that more vulnerable and protected, do we, what path does the economy then tread? Do we revert back to pre-COVID economic normal, in inverted brackets, so we resume all those sorts of economic behaviours that we had before, or do we, or has the experience of the last 6 months permanently shifted the way that some economic behaviour is conducted? Will we use Amazon less once we are able to escape the sort of the shadow of the coronavirus? Are we likely to commute 3-4 hours a day, 5 days a week to the office and not use home working at all. So I think there are some really important questions around the type of shape of economic behavior that we might have and might look forward to post the pandemic, and that will, how that unfolds will shape future asset allocation decisions. I think one of the key things I'm quite keen to get onto is in terms of the policy response. So COVID obviously is a pandemic, it's a global threat, but you've seen very different responses globally in terms of monetary and fiscal response. So this screen, this chart on screen here just highlights the fact that you had alignment when it came to monetary policy. So central banks were pretty uniform in cutting rates across the world. You can see their advanced economies almost 100% effectively all cut rates by varying degrees through to the summer of this year. If you then contrast that with the fiscal response, and that's been very more marked in terms of the difference. So this is looking, this is a chart from the IMF earlier in the year, and this is looking at additional spending and foregone revenue, excluding loans, as a percentage of GDP. And you can see here, US has clearly delivered outsized fiscal response at over 12%. That's more than double the G20 average. By contrast, some of the European countries, for example, were a lot less. So looking at Spain, looking at Italy, looking at France, for example. So I think the first point is when you're looking at the underlying economies and you're looking at markets, the two are not necessarily the same. And the reason for the performance this year, I think, is twofold. One, or the reason for the differential performance this year is twofold. One is the way that you've had different responses from government spending between countries. And obviously that will shape the relative speed of recovery of those underlying economies, dependent on the amount of support that they've had. The second is that stock markets are not perfect reflectors of the underlying economies. Stock markets have natural inbuilt tilts to certain sectors. So for example, with the US, the MSCI USA index has almost 30% of its weight towards technology stocks, for example. With the MSCI UK weight index, technology is less than 2%. So not only is there a sort of a differential fiscal response, which markets are paying heed to, but also markets are recognizing that there are some sectors which have been much more able to weather the pandemic, and therefore those sectors have been sought out, and the relative weight of those sectors as they change from country to country and region to region has definitely tilted that regional performance skew. I think one of the key messages I want to get onto, and I think it really does play to what unfolded yesterday, is this idea of inflation, reflation, return to normal. So if I was to try and summarize sort of a reflationary argument, that argument would suggest that we've seen huge outsized accommodation of central banks and governments. Money supply has increased massively year on year. So M2 has grown sort of 20% plus year on year. That's hugely reflationary. As soon as we get a vaccine, there's a lot more liquidity. And that's going to drive inflation. It's going to drive higher nominal growth. That's going to be a tide that lifts all boats. Suddenly growth will be less scarce. And so we need to think about maybe moving in towards more economically sensitive sectors, banks, industrials, commodities, away from those more defensive sectors such as healthcare and tech and so on. So, and also then taking money out of the US and putting it into Europe, emerging markets, what have you. I think what is important to recognize is that that narrative has a lot of holes in it. And the key one is that is this chart on screen here, and this is one of the key messages. That if you take away one message, I think from this whole presentation, I think this is the key message, and it's the way that the policy accommodation from central banks and policymakers from governments, what has that been trying to achieve? What has it been trying to deliver? If you hadn't had a pandemic and we'd all carried on as normal and economic behavior hadn't been disturbed, and you added this much level of policy stimulus, undoubtedly that would have been inflationary. But the level of policy stimulus that's been delivered has not come against a normal economic backdrop. It's come against a backdrop where you've had economies effectively shuttered by governments. So what you've had is a pandemic which is by definition deflationary. You know, if you physically prevent people leaving their homes to go shopping to spend money, that's a deflationary force on prices. So what governments have tried to do and central banks have tried to do is create an inflationary bridge over the risks of a pandemic-driven deflation. And apologies to Simon Garfunkel's sort of bridge over troubled waters, but it's a narrative which I think hopefully it creates a nice narrative in one's mind in terms of, there are sort of turbulent waters beneath us in terms of the risks of deflation, and we need to create a bridge to span that, and that's the inflationary bridge. I mean, what's interesting is that if you look on this screen here, this is looking at headline annual inflation rates for key economies, so the US, Eurozone, UK, and Japan. And despite the huge level of central bank accommodation, restarting QE, supporting corporate bond markets, for example, and despite outsized stimulus from central banks, so the furloughs from governments, so the furlough scheme in the UK, for example, direct money transfer in the US to citizens, despite all of that, your inflation is still below where we were over the last preceding 12 months. This slide is also quite a nice narrative, and it looks at the further sort of medium-term horizon. And it sounds complicated, five-year forward inflation expectations rate, but it's actually a very simple concept. What it's trying to do, this is trying to, this is a measure the Federal Reserve US tracks, it's on their website. And they try to observe what market instruments are telling us about the period of inflation over a 5-year period starting in 5 years' time. So if today is day zero, it's saying, what do you think the average inflation rate is going to be between the next 5 and the next 10 years, so between years 5 and 10. So as you can see here on screen, at the end of October, that rate was 1.81. I looked this morning, and that rate was, let me just find my notes, 1.83. So despite the huge level of stimulus, as I've detailed already, even the longer term inflation expectations rate is still well below the 2% rate that the Fed and central banks globally seem to target, and is actually broadly in line with where we started at the start of the year. So it's pretty much undisturbed. So again, that really supports the idea of a reflationary bridge. I think the next 2 slides also are very supportive. Hopefully I'm not labouring this point, but I think it's a really important point to get across, because it really does play into some of the events that we saw yesterday in terms of that rotation within the markets. If you are to see sort of global reflation and global growth pick up in terms of nominal terms, then you need to see inflation persist. So inflation isn't just created through a one-step change in prices. It's a durable, sustained, repeated pressure on prices upwards. And that's what drives more higher levels of reflation and nominal growth, for example. What you've got on screen here is the US money supply looking at M2. So this is looking at narrow money, so money that's readily accessible for spending, as well as M2, which is money held principally in deposit accounts, in savings accounts. And you can see here how early in the summer, between March and April, in terms of monthly change, there was a significant step up in money supply as the Federal Reserve tried to really drive through a inflationary bridge over those deflationary risks. But look at the evidence in the last couple of months, it's really pared down quite a lot. The other example illustrating the same point is the US Federal Reserve's balance sheet. So earlier in the year, US Federal Reserve balance sheet said, look, we're going to step in, we're going to provide support to prices, we're going to redouble our efforts on QE, we're going to buy 10-year treasuries, and that will keep the borrowing costs low and will keep the prices supported, and in turn it also adds to the balance sheet of the Federal Reserve, because the Federal Reserve is putting it onto the balance sheet. So between March and April, you saw a significant increase in terms of the weekly change, in terms of the growth of the Federal Reserve balance sheet. But again, look at the experience in the last few months, and in terms of that weekly change of the Federal Reserve's balance sheet, in some instances it's actually been negative. So again, for me, you're not getting that same impulse, that same persistent, durable idea that would create tailwinds for inflationary pressure. And I think that's a really important point. In terms of market performance, so I alluded earlier to the idea that markets are not economies. They respond this year, I think, to two things. One, the varied support that governments have provided in terms of fiscal spending, but also in terms of the shape of the stock markets, in terms of how they, in some instances, are more or less skewed towards sectors such as tech or healthcare, for example. At Brooks Macdonald, we've had a constructive view, a positive outlook on the US and Asia ex Japan this year. And I think that's suited us very, very well indeed. You can see here in terms of net total return percentage change year to date. In sterling terms, this is from the beginning of the year through to the end of October, so it excludes November. But you can see here very clearly the best performing regions globally was USA and Asia ex Japan. Obviously, I've split out Asia ex Japan just to highlight China in there. At the weaker end of the market, you've got EMU, which is the Eurozone, and you've got the UK as well. I think the narrative that we've held to has been very much the idea that you will see a low growth, low interest rate because of debt, a low inflationary world likely to persist, and that's likely to continue to favour these regions in terms of their relationship. In terms of another slide I would look at, this slide I think hopefully just reinforces the point. Markets are discounting machines, they present value the future. We've all done discounted cash flow analysis, and if you have a stream of earnings over the next 5 or the next 10 years, and you discount that back at 4 or 5%, the number you'll get will be much smaller than if you discounted those future earning streams back at 0. So with low interest rates and a low interest rate environment likely to persist for some period of time, then future earning streams are going to be much more highly valued. And so I think this also gets to the point about the shorthand that the market was obsessed with over the course of this year. As we hit the pandemic and markets fell, lots of debate about whether we would see a V-shaped recovery or a U-shaped recovery. And I actually think, you can see both, and both are going to be consistent. So in the U camp, the underlying economies, they're contemporary machines. It's the here and the now. They will take time to recover, even with a successful vaccine. That will take time to roll out. It will take time to immunize. I think people's habits, a natural aversion will take time to recede. In many ways, it's not just the virus itself, it's the fear of the virus which is the most economically damaging. So the underlying economies will take time to recover to normal levels of activity. Some will be more quicker than others. So the Chinese economy is proving to be very fast in terms of its economic recovery profile. Other countries will be slower. But the V camp, that's financial markets. And it may have been seen to be counterintuitive that you could have been hitting new highs with global equity markets over the summer at a point in time when we were still facing the ravages of a second wave of coronavirus. And that's because markets are looking much further out. It's often put to be, well, how can you be positive on equities or the US equities because of price earnings valuations, P valuations? And I think that misses the point that very often people are looking at the next 12 months of earnings. And the next 12 months of earnings really captures two key reasons. One is you're only capturing the outlook for the next 12 months. So you're ignoring the ability for companies to demonstrate very visible earnings streams in the next 5, the next 10 years, but also you're capturing the near-term impact to earnings this year, which is down, and therefore that naturally expands your price earnings multiple. Tech is not valued on the next 12 months earnings. It's not even probably valued on the next 5 years of earnings. Tech is being valued on 10 years of earnings, potentially, because they, through their business models, where they have high barriers to entry, in many cases, it's very easy to try and make assumptions about long-term earnings profile. And again, if you have that 0 interest rate outlook, then you can discount that back to the present, and that's more highly valued. If I can find one chart here, which I will highlight. This is the Federal Reserve dot plot, which sounds like something you might do at primary school, but it's basically a representation, a graphical representation of each of the Federal Reserve voting members and where they think interest rates will be at the end of each calendar year. So you can see here for 2020, 21, 22, there's pretty much broad agreement, apart from one person in 2022, that rates are going to be anchored at the very low end. And even in 2023, the median number is still very, very low indeed. And I think that underscores the view that interest rates are unlikely to move. And actually, if you start to see yield curves steepen, so yesterday the US 10-year bond yield had its biggest day rise since March, which incidentally followed last week when it's had its biggest day fall since March. So it's clearly moving around a lot. But I think really the message here is that the Federal Reserve will not be shy, I suspect, in redoubling efforts on QE and buying those further dated bonds to keep borrowing costs low and prices elevated. So I'm not convinced that you'll see a runaway steepening in yield curves that would support sort of cyclical value parts of the market, whilst the Fed would stand idly by and watch borrowing costs elevate at this stage in the nascent economic recovery. So I think that's also one to factor. This slide, I think just the next two slides, I think just gives you a bit of sense about how we're seeing the needs or otherwise of a fiscal response. So running into the US election, there was various hopes around a big fiscal spend, but I think actually it's less needed than many expect. On screen here, you've got US households and excess savings. So it's looking at the personal saving rate as a percentage of disposable income. I've taken February as kind of the base level. You can see here on screen that throughout last year up until February, it was pretty much around the same levels. And then as the coronavirus hit and as people's normal economic behavior was disturbed, we weren't paying for season tickets on trains, for example, you were naturally able, if you kept a job, to save more money. And you can see here how that savings rate really picked up over the next following few months. It's been my view that I think households can use that higher levels of saving and they can then redeploy that and support retail spending going forward. And you saw that in the most recent data in terms of US retail sales. So in September, US retail sales increased to the biggest annual gain since December last year. So despite the fact that there was intransigence in Congress in the US and that Democrats and Republicans couldn't agree an additional fiscal stimulus plan ahead of the election, despite all of that, you had a record number in terms of US retail sales. I think that's really, really important. I'm sure you've read, you're all an avid follower of our Brooks Macdonald website, and on our website we have an insights page where we highlight key and topical pieces of research from our central investment office. And one of the key narratives I've tried to highlight in quarterly market outlooks, both for Q3 and Q2, is this idea that this rally we've seen in equity markets probably has been pretty universally hated. And I say that because in terms of the participation, on screen here, you've got US money market funds. And you can see here that they saw a significant pickup over the course of this year. They've pulled down very recently. Now, some of that is because of corporates having raised money through debt and corporate bonds, and they've parked money in money market funds should they need to draw down on it in future months. But some of it also is a level of risk aversion as investors and asset allocators have taken money out of risk assets and put it into money market funds. I mean, 5 trillion for measure is close to around a quarter of US annual GDP. So it's significant. And I would contend that as you start to see nascent economic recoveries gather steam, and as you start to see more confidence in a vaccine, there'll be more money coming out of money market funds. The question I have is, where does that go? And I think that's a really interesting point, and hopefully that's answered by this slide. This is one of our sort of our signature charts at Brooks Macdonald, which I'm very keen on and has been highlighted as, if you follow us on LinkedIn, you'll know that every week we try to put out a chart of the week which hopefully is topical and sort of creates some debate. And the most recent chart of the week is looking at the earnings yield gap between equities versus government bonds. And all I've done here is basically take the price earnings ratio for the US market and inverted it so you get an earnings yield, and then compared that with the yield that you get on US 10-year treasuries. And you can see here that there is still a very significant positive gap between the earnings yield predicted in the next 12 months on equities versus bonds. And this is my point, going back to that slide in terms of money markets. So this slide here, if that money starts to come out of money market funds and it starts to chase risk assets, where does it go? Does it chase 10-year government bonds yielding less than 1%, or does it start to chase equity yielding more than 4%? Now, this is the picture for the US. If I look at the picture in the UK, it's a very similar story, obviously slightly wider, but again, you've got that support in terms of the equities earnings yield versus the bond yield. I've touched on the US election, I've touched on coronavirus. Clearly, there are a suite of risks that we monitor. It's often said that markets have to climb a wall of worry in terms of rising, and I think that's just as true now as it's ever been. And on screen here, you can see just some of the risks that we are keeping a close eye on. Inflation, which is middle of the screen there, hopefully, I think you'll agree we've covered that off reasonably convincingly. I think clearly, if you see a more durable policy response going forward, even once we return to normal economic behaviour, then I think that's a risk. But you know, what's telling for me is that I think it's very much a story of give and take. You know, when you look at the UK, for example, and there was an anticipation of Boris back in late summer of getting people back to work. They were trying to dial down that level of government support. So the furlough scheme, which was supporting 80% of unworked hours at the start of the furlough scheme, they had proposed, it was proposed originally that November would see that support down to 22%. Clearly, as the second wave pandemic has hit, and we've had to shutter more activity and go into a second lockdown, the government has responded to that by moving furlough back up to the original 80%. But the point was that the government wasn't willing to maintain the high level of support had we had a return to more normal economic behaviour. And I think that's the real critical point is when you think about the next 12, 24, 36 months, are we likely to see an environment whereby we have a return to normal economic behaviour and we have the continued sizable fiscal and monetary stimulus pervading? Or do you think it's going to be a question of give and take, that as the economy sees a return, so you'll see a step back in some of that accommodation? You know, Rishi Sunak, the UK Chancellor, has already highlighted about, I think he said, hard or difficult choices ahead, obviously perhaps with one eye on the next budget, which is likely due in March. And with the UK debt to GDP north of 100%, clearly that's going to be on his mind. I'm not suggesting that we're going to see a return to sort of a full metal jacket austerity. I think it's highly unlikely that you're going to see pay freezes for what we've come to recognise as essential workers. But I think there will be, at the edges, maybe slightly less accommodation than what we've seen in the last 6 months, simply because that's been needed to support economies that have been shuttered in normal economic activity. I think what's interesting in terms of trade wars, that's also unlikely to go away. I think under Trump, it was very much transactional presidency. So he was very much around the trade deal. You do something for me, I'll do something for you. I think Biden's going to be much more collaborative. He's looked to rebuild NATO and other global alliances with Western partners, and therefore he'll try and bring pressure. But I think he's also going to be very careful about being aggressive on tech regulation, for example. Clearly, there, you know, if there is a trade war, there's most definitely a tech war between the US and China. And I think if he comes down too hard on tech regulation, that potentially creates a void, an opportunity for Chinese tech to fill. So I think there is some modicum of balance there required. Brexit, I think I've managed very well so far. I haven't got through the presentation without mentioning Brexit or EU-UK trade discussions once. But obviously it's in my mind because obviously this week we have another deadline again. Middle of November is thought to be the latest deadline whereby you need a deal done, because then you need the necessary weeks remaining to the end of the year in order to get through all the paperwork to avoid a WTO exit after 31st December. I think the reality at the moment is that potentially, whilst I know overnight the House of Lords defeated certain elements of the internal market bill, Joe Biden has made no secret of the fact that he is not a fan of Brexit, and he's, I think, implied, well, more than implied, I think he's come out and said that there is no chance of a trade deal with the US if the UK pursues this path with the internal markets bill, which threatens border on the island of Ireland, for example. And Nancy Pelosi, who's the Democrat leader of the House of the Representatives, has also said that there is no chance of a deal if that's the way that the UK looks to unravel certain elements of the withdrawal agreement that we signed literally within the last year. So I think that's certainly one to focus on. My natural predisposition on UK and EU is that we'll get a deal. I think the EU specialises in 11th hour sort of clutching victory from the jaws of defeat type deadlines, and I think we'll end up getting a skinny deal around goods, but maybe there'll be further negotiation required around services, for example. So when you look at CETA, which is the Canadian agreement, which Boris Johnson has highlighted, that doesn't allow for any automatic passporting of financial services in Europe, for example, and it's very much orientated around goods. So I think my base case, I think our base case is that we have a deal of sorts, and Boris will present that as a victory, but I think the devil will be in the detail, and there'll probably be more work required in terms of the services elements within any trade discussion. I think in terms of finishing, I would just highlight how our regional preferences are set.
Give us a second, everyone. Matthew, I don't know if you can hear me, Matthew, but I don't think we can hear you now.
Again, it's popped up again.
Yeah, that's it, Matthew. If you can hear me, I think you're back.
Brilliant. Okay, good. So hopefully that was a small interruption there.
It was, yeah. It was only very brief. Yeah.
Good. So the last slide I'll finish with, conscious of time, is regional preferences. And it's important to highlight that we do have balance in our portfolios. So over the last 12 months, we have been reducing the underweights that we held relative to benchmark for UK equities, for example. And with UK equities, obviously, we have an exposure to small and mid, and also to more economically sensitive stocks. We have a negative outlook, but a marginal underweight undeveloped Europe. We have definite overweights on the US and the Far East. I think what's important to get across is that clearly news of a vaccine will be taken positively, and the scale of yesterday's moves, I think, just underscores just how unloved and lowly valued some parts of the market have become. But even if we imagine a world whereby we have a vaccine and we have the ability to return to normal economic behavior, what is the context that we're going to be operating under? And I still think it's going to be one whereby, given that we don't have that blue wave Democrat majority, that there's all likelihood of Senate, for example, maintaining control, the Republicans maintaining control of the Senate, I think the expectations for a fiscal spend have really dialed down. So there's not going to be that huge unbridled spend in terms of a regenerative sort of shift in terms of infrastructure. That suggests that the central banks, the Fed, will have to do more, and that suggests that the tilt of accommodation will still be around low interest rates. And if you're in this world of low interest rates, contained inflationary pressure, and lower nominal global growth, then that's still going to be a longer term environment that will still be supportive of those longer duration growth assets, such as things like tech and healthcare. So you are very likely to see sometimes quite violent sort of short term swings and repositioning. But I think for me, I would reserve judgment about reducing my enthusiasm for areas such as tech and healthcare. Only if we were to see a convincing sort of reflationary narrative build. I'm not sure we have all that necessary evidence yet, but I'm happy to finish there. Conscious that I'm sort of coming up on the 20 past mark, so keen to leave some time for questions. But hopefully that was a helpful sort of recap on some of the key themes.
Yeah, thanks very much, Matthew. That was very informative, and obviously there's plenty to talk about at the moment, considering what's gone on over the last week, and then yesterday and even today, you've seen markets rally, and it's the unloved cyclical parts of the market which seem to be doing well again. So yeah, we're going out to questions now. As Stephen's pointed out in the chat function, if you do have any questions, if you just submit them through the Q&A. We've had some questions in ahead of this morning. I suppose the first one is just around the huge fiscal stimulus that we've seen over recent months and how we go about paying that back. Yeah,
no, I think that's a very good one. I mean, this chart here, if I just go to, so I can go to the chart here. So this chart here on the screen looks at the UK public debt, and I think it is a real challenge. I think it would, the IMF recently came out and said it would be a mistake. Interesting, actually, they broke from their previous guidance. So post GFC, IMF was much more about fiscal restraint, trying to pay down the level of debt accrued from GFC. This time around, the IMF said, well, actually, it doesn't make much sense to be too quick on that, and that actually you can take advantage of those low interest rates to service that debt. But I think it's clearly a concern, and you've got two quotes on here from the Chancellor from March and September, and he's taken opportunities time and again to stress the importance of fiscal responsibility, about responsible management of finances, and again he's talked about hard choices or tough choices ahead. I think what's likely is that you will see in the near term at least, again, and I think it points to that trade-off that whilst economies are still partly shuttered and that normal economic activity hasn't returned, then policymakers will support that and they'll take advantage of low borrowing costs in able to do that and service that debt. And I think that also goes back to the point about, you've seen a big steepening in yield curves in the last 24 hours. But will central banks sit idly by and watch those borrowing costs rise for consumers and for businesses and for governments when there is a need to be able to service that higher level of debt to support the economy, which is in still quite a fragile, nascent economic recovery state? And so my view is that I think in the near term, no one's going to worry about fiscal restraint. I think it's all about basically shielding the economy during the worst parts of the pandemic. And as Joe Biden said yesterday in his president-elect statement about the Pfizer-BioNTech drug, it's going to be many months before we have the ability to immunize broad swathes of the population. So for the next 6 months at least, I think any talk of fiscal restraint is off the table. I think what is key, though, is that interest rates will have to stay low to enable governments to help service this debt. And I do have a suspicion that we enter a world whereby we may even have a GFC, post-GFC redux, where effectively you have, governments have three ways they can pay down debt. They can write it off, which is never appealing. They can try and pay it back. We've tried that and that doesn't work. Or we can try and inflate it away. And what you have is financial repression, whereby you effectively keep bond yields at the long end very, very low and keep interest rates low, so that it's below the levels of muted inflation. And that way you effectively get financial repression where you erode the real value of debt. So, one of the big arguments I've had is you need bigger negative real interest rates to erode debt. So if you think that, Andrew Bailey and Jerome Powell, they've both got a natural aversion to think about negative interest rates. So if interest rates are capped at 0 and you have inflation, which is at 2%, the biggest negative real interest rate you're going to have is -2%. and you might need bigger negative rates in order to erode that debt pile. But I think there is a risk of financial repression creeping back in again. I think the next 12 months, 6 months is going to be really interesting to see how the expectations open up about whether we start to see some opportunities for a stronger global normal growth reflationary world. At the moment, I don't see evidence for that. But if we start to see some evidence of that, then I think that would definitely tilt the way that we would think about asset allocation. And I think we would see a much stronger move away from US to non-US equities and towards more the economically sensitive parts of the market. But I think, yesterday's move is an adjustment, reminding people about the vaccine news. I think, not keep going back to Biden's statement, but it was a very comprehensive statement. He said that, this news yesterday was only in line with the expectations that they were always going to be expecting some vaccine approval by the end of November. So in his mind, this is entirely in line with that. This is new news in terms of the high level of efficacy, if it holds that, for that particular drug. But in terms of actually getting a vaccine that could work and could be approved, it was always the case that they were expecting it by November. So the market's got a reminder that in the doom and gloom of the second lockdown in the UK, there is some hope, light at the end of the tunnel. But I keep making the point, when we get back to a post-COVID world, do we revert back to all the normal pre-COVID economic activities that we engaged in, or do we do things slightly differently? And if there is a higher technological healthcare element to that, then that will shape asset allocation, I think. Sorry, it's a rather rambling answer to your question, Andrew. Sorry.
No, it's good. Matthew, can I just build on that? And Andrew, does one of the things that potentially changes the new world, or the post-pandemic situation, is one of those, the environment and climate change, which is obviously massively important. We keep hearing, quite rightly, I would suggest, is that you've not touched on that, and not that you should have, but does that play into this potentially different way of looking at things, and therefore asset allocation, etc.?
Yeah, no, 100%. But if I take you onto this slide, our latest asset allocation portfolio guidance, at the meeting, we had a meeting yesterday, but the preceding meeting in October, we actually introduced a sustainability theme. So it's a lot of numbers here, but if you look down the left-hand side, you can see the various classes. And under international stroke thematic equity, we added to that by taking 1% out of cash and putting it into thematic equity across the board. And then we reallocated 2% away from international into thematic, because we added 3% across the board to a new sustainability theme. So really echoing our responsible investment service. And it's exactly to your point about the fact that there is likelihood, more of an urgency, more of an interest, more of a desire to look at more sustainable investing, and recognizing the challenges that we face in terms of climate, and in terms of how that shapes environmental, social, and governance for companies. So absolutely, I mean, that is a really important part of Brooks Macdonald's offering. And we've had some success for some time now within our responsible investment service, but we were very keen to express that explicitly within our asset allocation model by having that 3% across the board to the sustainability theme. So we now have 3 explicit themes. One is tech, one is healthcare, and one is sustainability.
I would add there, Stephen, just on that point, when meeting with clients, it's coming up an awful lot more in terms of their interest in understanding how their investments are being used to try and develop these different areas, whether it's helping out with the environment or society, governance. So I think there's multiple reasons why it's growing as an area. We see the diversification benefits of it too. And so I think it will become an even bigger part over the coming years, just because of the interest that we're seeing in our daily lives, and that's being reflected into the way we're managing portfolios.
Excellent. No, thank you very much, gents. Aware of the time, and we should obviously try to finish in the hour that we agreed. So I'll wrap things up, if that's okay, gents. Thank you, Matthew and Andrew. Matthew, an excellent run through some very interesting points. You managed to, as you rightly said, almost not mention the B word. The B word has been overtaken by the COVID word now these days, but you did mention it, and rightly so. But more importantly, you managed to get a reference to Simon and Garfunkel in, which I thought was entirely appropriate and should be in every presentation you do, I think, Matthew, to be fair. So thank you both very much. Thank you all for joining us this morning. Hope you've enjoyed it. And as always, this has been a K. Johnson G event with Brooks Macdonald this morning, helping you and your clients build a better business. If you've enjoyed it, we've been K. Johnson G. And if you have not, we have been KPMG. Have a good day, everyone, and look after yourselves. Thank you all very much.